Good morning. We will pay attention to the perpetual inventory system today and determine how the different transactions are recorded when the perpetual inventory system is used. If goods are purchased for cash, it means that we will increase inventory because in the perpetual inventory system, you use an inventory account the whole year and any movement of your inventory is recorded in this inventory account. And the bank account will be credited to reduce the amount of money in the bank. If goods are purchased on credit, we buy from creditors, so my liability will increase on the credit side and my asset for inventory will increase on the debit side. If goods are sold for cash and we use the perpetual inventory system, we have to do two double entries. The one will be at sales price and the one will be at cost price. So the first one at sales price, we will debit the bank to increase the amount of money in the bank with the sales price, the money that we actually received. Our income is at sales price because that is the amount that will increase my profits. Then a second entry will be completed for cost of sales to increase the expense for the goods that was purchased with the purpose of selling, and we say the cost price of goods already sold will be debited with the cost price. Any entry in the inventory account will always be at cost price, so the inventory is decreased with the cost price. When goods are sold on credit, we will do exactly the same as what we did for goods sold for cash, except that this is now a credit transaction, so the debtors control will be debited instead of the bank account. You will still credit the sales account because the amount that the debtors owe you is the sales figure, and your income must increase with the sales figure. So those two must be your double entry. Then cost of sales will be increased on the debit side at cost price to show what is the cost price of the inventory that was sold, and our credit inventory to indicate that we have less inventory. If goods are returned to creditors, it means that the creditor's control will be debited because we owe less money to the creditor and liabilities decrease on the debit side. Inventory will be credited because the asset decreases on the credit side. Goods returned by debtors. The debtors' allowances and inventory will have two different amounts. So we will do two double entries again when goods are returned. The one will be for debtors' allowances to show that the sales that we had in that previous transaction there is actually reduced with this debtors' allowances figure. And debtors control owe us less money, so debtors control will be credited. Inventory will be debited because we receive the inventory back now from the debtors, so it means we have more inventory available, assets increase on the debit side, and my double entry will be the expense for cost of sales will decrease on the credit side. So debtors' allowances decreases sales. Sales is always on the credit side, therefore debtors' allowances will be on the debit side. And whether you sell goods for cash or you sell goods on credit or goods are returned by a debtor, if you use the perpetual inventory system, you will always do two double entries. A double entry at sales price and a double entry at cost price. Inventory donated means that the inventory was taken and therefore the inventory was reduced, so inventory decreased on the credit side and we create an expense for donation. Payment of carriage or import duties. If you use the periodic system, you will put this under a carriage on purchases or import duties. In the perpetual system, all expenses that you pay from the time that you buy the asset until it's delivered to your premises will go into the inventory account because it forms part of the cost price of inventory, and your bank account will be credited. The owner took goods for its own use, so therefore drawings is debited. If the owner takes goods for its own use, it means the inventory that belongs to the business will decrease, therefore inventory will be credited. If we take stationery out of the business to use in an office or, for instance, for a promotion, then we will reduce our inventory on the credit side and we will create an expense that will reduce your profits. When the perpetual inventory is used, the purchase price and all the expenses that you pay from the time that you buy the goods until it's delivered to your premises will form part of the cost price of inventory. Therefore, all these expenses, import duties, carriage on purchases, shipping fees if you import the things, will form part of the cost price, and all of it will be entered in your inventory account. All expenses incurred to get the goods in a condition and location ready for sale will be part of the cost of sales. So that import duties that you pay, the carriage on purchases will form part. If you receive the goods and you have to change it so that you will be able to sell it, it will form part of the cost price of the goods. The value of inventories on hand can be determined by balancing the inventory account. In the periodic system, the only way that they can determine what is the value of inventories is with a physical inventory count. In the perpetual system, you can determine it by balancing the inventory account. Inventory shortages can be traced. If a physical count is done, you can take the physical count figure and look at the inventory account figure, and the difference between the balance in your inventory account and the physical inventory count will give you the inventory shortage. An entry will be recorded for this inventory deficit to reduce the value of the inventory and create an expense inventory deficit to reduce the profit. If you decrease your inventory as a result of inventory written off to net realizable value, you will decrease your inventory. If there's a fire or a burglary and you've lost inventory, you will create an inventory loss account and you will decrease your inventory.